and a great welcome to this particular session. So far in this particular chapter, we have finished till up to section 3, and section 3 and section 2 were heavy sections related to common control, demergers, sale of divisions, and besides status split-offs. So after acquainting ourselves quite well and thoroughly and comprehensively with the cases of common control, now we move over to another section. That this particular section should not actually pose you much difficulty, to be very honest with you. It's quite simple topic, but still we have to do this one. And in this section I'm talking about, we are going to see the accounting aspects in the books of inquiry. As a professional student, you need to know that also. Accounting aspects in the books of inquiry, although not very tough. In the books of inquiry, you need not require to write at this moment. In the books of inquiry. Correct? First of all, you need to understand that when I say company A has acquired company B, just wait. These sheets are falling down over here, so lots of sheets are there. When I say this entity is taking over this particular entity, mostly we mean by this particular phrase is that we are acquiring the control of this particular entity. And I have already told you, generally the control is acquired when we invest in this particular entity or in the investing entity, and our controlling stakes are more than 50%. Correct? Suppose we have invested in 70% stakes of company B, so quite obviously the control will shift to us. When we acquire control this way, that means entity B is still running, it is operating. It is not closed down yet. So one way of acquiring the entity is that you can get the control of that particular entity. But in that case, this entity will function, it will continue doing the business, it will operate in normal usual fashion, but only thing is that it will have to what we call function according to the directions furnished by this particular entity, because this has now become the parent entity and this is the subsidiary entity. However, we may say casually that we have acquired what we call company B, but the fact is that we have just acquired the control and company B is still in existence. Correct? This is one way of acquiring the other entity. However, we can acquire other entity this way around also. For example, entity A this time purchases the net assets of entity B. This time we did not make any investment in the share capital of company B. We simply asked company B to give us all of your assets and liability. In this case, now company B is actually purchased by this particular entity. In this case, entity will close down. Its business will cease to exist. Are you getting my point or not? So there are two ways of acquiring the other entity. One way is by way of what we call investments in the other entity and getting the majority stake and controlling that entity. But in that particular case, this particular entity will continue to function and operate. However, when we acquire the net assets of the other entity, in that case, the existence of the other entity will cease to exist, correct? And its business will get closed down. So in that case, this entity will have to do some accounting. In the similar manner, if you remember in your earlier phases of education, especially under dissolution of partnership, this is the chapter you have already actually faced in your earlier phases of education. And if you remember, when a partnership business gets closed down, you used to actually prepare accounts like realization account, partners capital account, cash account, etc. So similar to that, company B now will what we call do some accounting. So that is what we mean by accounting aspects in the books of inquiry. Remember one thing, accounting aspects in the books of inquiry under Ind AS 103 will come into play only when we will acquire the other entity this way around by acquiring their net assets and not by what we call investing in their entity. Is that clear to you? In this particular case, company B will cease to exist. So this is the point which you need to understand first of all before we move further. Now, as I told you, books of inquiry. Books of inquiry, this concept will come only when acquirer acquires acquiring by purchasing its net assets. Its net assets, and acquiry will cease to exist. Acquiry will cease to exist. So its existence will be no more now, cease to exist. Then only some accounting will have to be done in the books of acquiry. So, as far as accounting is concerned, correct? Under such cases, acquiry company shall open following accounts. So acquiry company, in order to do the accounting, will open the following accounts. Correct? What are those accounts? A, realization account. As you used to actually open, as I just told you, when you used to do chapter dissolution of partnership. Realization account. Besides that, you used to open partners capital account, that is owners capital account. But in case of company, owners will be shareholders. So you will open shareholders account. Shareholders account. And you used to open cash account also, if you remember, cash bank account. So we shall open it too. Cash bank account. However, besides these three accounts, acquiring company are going to actually open another account. That is acquirer company account. Acquirer company account, because acquiring company is going to receive some purchase consideration because they are selling their net assets. So in order to keep track of that, they will have to prepare acquirer account also. So these are the four accounts which this particular entity, acquiring entity, shall actually open. Is it clear to you? Now, next step is how to do the accounting then after opening these accounts. Our first step will be to close our asset side. Step 1, closure of asset side. In order to close the asset side, what we are going to do, just pay attention. The asset side of an enterprise or of an entity can be divided broadly into two parts. On the asset side, we may say there are two types of accounts. On the asset side I am talking about, I am not talking about assets. I am talking about asset side. Now you may wonder actually, if I am talking about assets, then why I am not saying that I am talking about assets. I am talking about asset side. Actually, there is a difference between asset side and assets. What is that difference? I will just let you know in a short while. The entire asset side can be divided into two parts, as I said. One, I would say assets. Actually, if you look into the framework of Ind AS, it states that assets are resources which are controlled by an enterprise and which are capable of fetching you economic benefits in future. Those items are considered as assets, correct? Whereas asset side not only includes asset, but it also includes some items which for simplicity's sake, I will call valueless asset. There is no such term. This is just for simplicity I am writing. Valueless items. For example, there are items like preliminary expenses, underwriting commission, discount on issue of debentures, etc. These are valueless items, but they appear towards the asset side, especially under other non-current asset or under other current assets. Such items generally appear over there. But they appear towards asset side not because of the fact that they are assets in real term. They appear because of the fact that they are basically deferred expenditure, which haven't yet been which haven't yet been actually written off, and that is why there is a debit balance in those items, and that is the reason why they are appearing towards the asset side. So asset sides basically comprises of valueless items and assets. Remember one thing, if you are going to purchase the business of somebody, you are going to purchase only the assets. Are you going to take over their valueless items? Definitely a big no. Correct? So remember one thing, when we will do the accounting, don't let it skip out of your memory that the purchasing unit or the acquirer will take over your assets and liabilities only and nothing else. Correct? Now, we have to close the asset side. In order to close the asset side, what we are going to do, first of all, I'm going to take all the assets other than cash and bank. All assets other than cash and bank. All assets other than cash and bank. Whatever assets are there other than cash and bank, correct? Whether those assets are tangible or intangible, including goodwill, patent, trademark, goodwill, plant, machinery, correct? So all assets other than cash and bank, you are going to transfer them to the debit side of realization account. Transfer to the debit side of realization account. We will transfer such assets to the debit side of realization account, importantly, whether taken over or not. Whether taken over or not. Whether these assets have been taken over or not, irrespective of the fact, we are going to transfer them to the debit side of realization account, and all these items will get closed now. Then what will be the treatment of cash and bank? So we have to exercise a bit of caution with respect to cash and bank. As far as cash and bank is concerned, cash and bank. As far as cash and bank is concerned, you have to see whether cash and bank has been taken over or not. If cash and bank has been taken over, then you are going to transfer it to the debit side of realization account, similar to all other assets. Correct? If taken over. When I say if taken over, T/O means taken over. If taken over, I mean to say taken over by purchasing unit. If your cash and bank balance has been taken over by purchasing unit, then transfer to debit side of realization account. Debit side of realization account. Then in that case, I am going to transfer it to the debit side of realization account. Is it clear to you? However, if not taken over, sometime it would be given in the question that company is taking over your asset but not taking over your cash. So in that particular case, you should not transfer cash bank balance to realization account. Rather, in that case, you will transfer it as transfer to cash bank account. So in the cash bank account, you simply write to opening balance brought down to cash bank account. So we have to exercise caution only with respect to cash and bank. Besides cash and bank, whatever other assets are there, whether tangible, intangible, all those assets will be transferred to the debit side of the what we call realization account, whether taken over by the purchasing company or not. Without bothering about that particular fact, you are going to actually transfer all such assets to the debit side of realization account. That is important to keep in mind. Besides valueless item, there may be some valueless items such as preliminary expenses, as I told you. Preliminary expenses, underwriting commission, discount on shares, discount on debentures, correct? So whatever deferred expenditure are there, because they are valueless items, quite obviously new company is not going to take them over. But however, you will have to close them. So whom will bear these type of losses. Technically speaking, these items are nothing but losses. So losses will be borne by the owners. Owners are shareholders. So you will transfer them to the debit side of shareholders account. To the shareholders account. You will transfer all these items to the debit side of shareholders account. This is how you are going to close your asset side. Is it clear to you or not? Yes, sir. After closing down your asset side, all your items of asset side will get closed. So now the next point is to close your liability side. In order to close your liability side, what you are going to do, see here, your step number 2 now. Second step. Closure of liability side. In order to close your liability side, first of all, you need to understand that your liability side can be actually bifurcated into such headings like this. Towards the liability side, we may have capital, share capital. Purchasing company will not take over your share capital. It is not possible. They will take only your liabilities. So share capital will be transferred to the credit side of shareholders account. Transfer to credit side of shareholder account. So this way you are going to close your share capital. Besides that, you may have reserves in the liability side. Again, reserves shall not be taken over, quite obviously. Correct? As we know, reserves are of several types. There may be some reserves like free reserves. Free reserves such as general reserve, reserve fund, or sometime it is given as retained earnings, profit and loss, one and same thing, security premium, workmen compensation fund, WCF, workmen compensation fund. But you have to exercise caution with respect to funds. Funds are free reserve, no doubt about that. Suppose there is balance of 50,000 in workmen compensation fund. If nothing is mentioned, you presume this fund is completely free. However, sometime in case of funds, it may be given to you that some portion of the fund is meant for liabilities. Say you are given workmen compensation fund of 50,000. Besides, the question also states that out of 50,000 worth of workmen compensation fund, 40,000 is meant for workmen liability. So in that case, transfer only 10,000. Similarly, insurance fund, IF, insurance fund, correct? So all these are free reserves. Free reserves are nothing but sort of accumulated profit. Through your efforts, you have accumulated and made so much of savings. So why the hell in the world you are going to get imparted with that? You are not going to transfer it to the purchasing unit. So quite obviously, again it will be transferred to shareholders account. Transfer to the credit side of shareholders account. We are going to transfer it to the shareholders account. Correct? Now, as far as reserves are concerned, there may be some specific type of reserves. Before that, let me come to statutory reserve. Then I will talk about statutory reserve. As you know, statutory itself is signifying that something which is compulsory, mandatory. Statutory reserves are generally made by such entities which operate in a special economic zone or what we call free trade zones or any notified zones. Because generally when an entity operates under such zones, there are some compulsions, there are some foundations upon this entity to transfer some portion of their profits to these type of reserves, like foreign project reserve account, foreign project reserve account, foreign project reserve account, like investment allowance reserve, investment allowance reserve, investment allowance reserve, like development reserve. Honestly speaking, investment allowance reserve and development reserves are one and same thing. All these are statutory reserves. Even T-board reserve is also a statutory reserve, correct, which you study under your income tax. So if you come across any statutory reserves, these reserves, you have the alternative here. You have a choice here. You can either transfer to the credit side of realization account, or you can transfer them to what we call credit side of shareholders account. My advice is to transfer them to credit side of shareholders account. Transfer to credit side of shareholders account. Correct? Now, because entity is closed down, so there is no further foundation upon the entity to carry on these reserves. So whatever balance is there, that automatically becomes free. So on that basis, we may say that it should be transferred to shareholders account. Besides, reserves, as I told you, one, we may categorize it into free reserve or statutory reserve. Besides, we may also see some type of reserves like specific reserves. Specific reserves. Now, specific reserves are nothing but all the provisions. All the provisions are known as specific reserves because these reserves are basically created particularly, specifically against a particular asset. For example, provision for doubtful debts. Provision for doubtful debts, PFDD. Provision for doubtful debts. Like provision for depreciation. Provision for depreciation. So these are specific sort of reserve. If you come across any specific reserves, in that case it is better to transfer them to the credit side of realization account. Credit side of realization account. Reason is that their corresponding assets against which these provisions are made are transferred to the debit side. So that is the reason it is better to transfer them to the credit side of realization account to close them out. Now, whatever we are left towards the liability side, correct, after share capital and reserves, those items are classified as liabilities. Liabilities basically means amount due to outsiders. Outsiders basically means third parties, correct? First party is the entity, second party is the owners, and whatever amount is due to the third party is known as liability. Whatever liabilities are there, whether sundry creditor, bills payable, etc., you are going to transfer them to the credit side of realization account, whether taken over or not. Transfer to credit side of realization account, whether taken over or not. Whether taken over or not. Irrespective of the fact whether liabilities have been taken over or not, we are going to transfer them to the credit side of realization account. Is it clear to you that now, after the second step, your balance sheet is closed? That when you have closed each and every item of asset and liability side. After having closed down your asset and liability side, the next step is that you are selling your business, that is net assets. So against the same, you are going to actually receive some consideration, correct? So acquirer company will provide you some consideration. So third step is accounting for consideration. Accounting for consideration. Consideration means purchase consideration. You will receive the consideration. So first of all, you will pass an entry, acquirer company account debit. You are going to debit acquirer company account debit with the amount of consideration to realization account. Actually, acquirer company will not immediately pay you. Generally, a deal is made first and then after some time you will receive the amount of consideration. So when deal is struck with the acquirer, that means commitment has been made from both sides. Well, we are ready to actually sell our business and we are also ready to pay you the consideration. So when such commitment has been implemented, taken place, then acquiring company is going to pass this entry, because on that date legally acquirer has become a debtor from the perspective of acquiring. Acquiring is supposed to receive this much of amount. Now it is a gain to the acquiring, so that is why they are going to credit realization account, which happens to be nominal account. Then we are going to receive the consideration. Now acquirer may discharge the consideration by paying you the amount through cash or through shares or other securities. So whatever may be the mode of payment, you are going to debit it. For example, if some portion is received in cash, you are going to debit the cash account. Some portion is being received through shares, then you are going to write shares in acquirer company account. In acquirer company account. And so on. To acquirer company, because you will receive the purchase consideration from acquirer. Quite obviously, when you will receive the consideration from the acquirer, acquirer's account will get closed down. Is it clear to you? So these are the two entries which you are supposed to pass in respect of consideration. Now the next point is that you have to look carefully whether there is any asset which hasn't been taken over by purchasing unit, and whether you have sold that asset. So if there is any asset not taken over by purchasing company and you have sold it, then you are going to pass an entry. Asset not taken over and sold. So if there is any asset which hasn't been taken over and it has been sold, then you are going to pass a simple entry, cash account debit to realization account. Don't write to asset account, because you have already closed that asset by transferring it to the debit side of realization account. I have already told you whether any asset has been taken over or not, that must be transferred to the debit side of realization account, isn't it or not? So realization account. Then similarly, I will talk about liability. If there is any liability not taken over, then you will discharge the same. Liability not taken over. If purchasing unit hasn't taken over any of your liability, so it is your duty to discharge that particular liability. So your entry will be realization account debit. Don't write liability account debit, because we have already closed our liabilities by transferring them to the credit side of realization account. Realization account debit to cash account. This will be our entry. Correct? Then next thing is with respect to expenses. So when an entity acquires another entity, there may be some expenses in connection with the same, because generally when we acquire some entity, we may need services of some experts also, correct? Some advices also. So such expenses may be there. Now the treatment of expenses like this. If such expenses are borne by acquirer, if acquirer has borne these expenses, if acquirer company has borne these expenses, then quite obviously acquiree is not going to pass any entry, correct? Only acquirer will pass the entry in its book. Acquiree will not pass any entry. Will not pass any entry. Acquirer will pass following entry. Acquirer will pass following entry. Following entry. What will be that entry? The entry will be profit and loss account debit to bank account. Because Ind AS 3 clearly states that such expenses will be treated as acquisition cost. Such expenses will be treated as acquisition cost, and acquisition cost incurred by acquirer will be expensed. It is clearly mentioned, so that is the reason we will debit our profit and loss account. We'll pass this entry in the books of acquirer. Now, if expenses are borne by acquiree, borne by acquiree. If expenses are borne by acquiree, then acquiree is going to pass a simple entry, realization account debit to bank account or cash account, whatever you may like to write. Correct? So, as far as expenses are concerned, very simple. Borne by acquirer, no entry by acquiree. Borne by acquiree, acquiree is going to pass simple entry, realization account debit to bank account. Now, after this was step number 6. So now step number 7. After that, we are in a position to know our results. So first we are going to tally under step number 7A. We are going to tally realization account. We will tally realization account. Whatever result is there, that is profit or loss, whatever that result will be posted to shareholder account. Correct? Then we are going to tally after that cash bank account. Whatever balance is there in the cash bank account, that will be transferred to shareholders account. It means whatever balance is there, that will be paid off to shareholders account. Finally, shareholders account shall automatically get closed. Shareholders account shall automatically get closed, and that will simplify that whatever you have done is correct. Is it clear to you or not? So this is how you are going to actually do the accounting in the books of acquirer. Now we take question number 4.1. Question number 4.1. So let me actually first, question number 4.1. Where is question number 4.1? Just wait. Yes, this is the starting of section 4. So as far as section 4 is concerned, correct? Section 4, books of acquiree and acquirer. Of course, we'll do the accounting in the books of acquirer too, but mainly we are concerned with books of acquiree. Question number 4.1, but question actually sets off from this particular sheet. Question states that the following is the balance sheet of Stoff Limited as at 31st of 12/2022. Now, if we look into the balance sheet, we find there is share capital to the extent of 10 lakh, then There are reserve and surplus to the extent of profit or loss account 30 and general reserve 3,70,000. There is no security premium. I have just written to tell you that it is also a part of reserve and surplus. Then as far as non-current liabilities are concerned, we have only one liability in the form of 12% debenture, 1,50,000. Current liability in the form of creditors, 2,10,000. There are two liabilities, and besides that, I have written bills payable, but there is no bills payable in this question, so only 12% debentures and creditors are there. As far as asset side is concerned, land and building were 3 lakh, plant and machinery were 6,70,000. Preliminary expense have been given to you under other non-current asset. It is a valueless item, 10,000. Goodwill is also given to you as 50,000. Goodwill is intangible asset, and then there is a difference between intangible and valueless asset. Then inventory is stock 450, debtors 250, and bank 30,000. Now below it is given that Start Limited acquires the business of Stop Limited. Start Limited acquires the business of Stop Limited excluding or accepting cash at bank and 12% debenture. Very important to understand first of all the impact of this particular line. It is very important to understand the impact of this particular line. Why it is important? See here. If you will look into the question we have, I have already told you, as far as liabilities are concerned in this question, there are two liabilities in the form of debentures, 1,50,000. In the form of creditors, that is 2,10,000. There are two liabilities. As far as asset side is concerned, we have already seen land and building, plant and machinery, and preliminary expenses will not come there, but goodwill is there. Then stock is there, and debtors and bank. Debtors and bank. So these are the assets. Now question states that purchasing company Start Limited is taking over Stop Limited except cash at bank and 12% debenture. So in this question, it means cash is not taken over. Indirectly, it means all other assets have been taken over. Further, it is given it is not taking over debentures. It means creditors are being taken over. Further, it is also given to us for rupees 16,80,000. That means purchase consideration or consideration amount is also given to you. And we will see in the upcoming questions that we will have to compute the consideration. In this question, it is given. So consideration amount is 16,80,000. Correct? Further, it is given how purchasing company will discharge the purchase consideration. It is given that purchasing company will pay 15 lakh in the form of 1 lakh equity shares of 10 each at a premium of 5. Purchasing company will discharge purchase consideration by issuing shares, and it is being told to us that 1 lakh shares of rupees 10 each will be issued at a premium of 5. At a premium of 5 per share. That means 1 lakh share at the rate of 15 are being issued. That means out of 16,80,000, 15 lakhs shall be received by way of share, and balance quite obviously will be received by way of cash as it is written over there, and balance in cash. Is it clear to you? Then it is also given Stop Limited redeemed its debenture at a premium of 10%. At a premium of 10%. Stop Limited redeemed its debentures at a premium of 10%. Correct? I have already told you that 10% debenture is a liability which is not taken over. But I also told you that whatever liabilities are there, those liabilities you are going to first of all transfer to the credit side of realization account. So that means you must have transferred debentures and creditor to the credit side of realization account. Now because this liability is not being taken over, so you are going to actually pay them off later on. And when you will discharge the liability, your entry will be realization account debit to cash. So 10% debenture 1,50,000, and you are discharging them at a premium of 10%. That means total 1,65,000 you will pay and write it towards debit side of realization account. Then it is given to you that expenses were there are expenses Acquisition cost amounted to 10,000 and borne by Start Limited. So Start Limited, which is the purchasing units, is bearing these expenses, correct? And nothing else is given. So now we are in a position to do this particular question, correct? So I will keep all these sheets over here. So in order to do question number 4.1, correct? First of all, I will prepare realization account as I told you, but it is always better to start with acquirer's account. It is not mandatory, but I am just telling you that it is better to prepare books of acquiry. In the books of acquiry, you are going to open up following accounts. One is acquirer account. Besides acquirer account, you prepare realization account. Intentionally, I am preparing realization account this way just to escape myself from shifting to other sheet. Realization account. This is my realization account. Besides realization account, as I told you, I will prepare shareholders account. So I will prepare shareholders account. This is shareholders account. Shareholders account. And then finally, I will also prepare cash bank account. So these are the accounts which the acquiring company will have to prepare. The first step is to transfer all the assets, correct? First step is to close the asset side. In order to close the asset side, we will have to look towards the asset and just post them over here. So I will write here, as far as asset is concerned, one is land and building. So I will write here land and building. I have already told you that all the assets, whether taken over or not, we are going to post them here. However, in this question, land and building has been taken over. That's a different matter. Even if land and building would not have been taken over, I would have still transferred it over here. Plant and machinery, according to the question, is 6,70,000. Besides plant and machinery, we have preliminary expense. I told you preliminary expense are valueless items and purchasing company will not take them over. These valueless items will be debited to the shareholders account. So I will put them towards the debit side of shareholders account, 10,000. Then there are three other items, stock, debtors and bank. So stock, I am going to write it over here. Stock amount is 4,50,000. And then we have debtors. Amount of debtors is 2,50,000. Besides, we have cash bank balance. So this time bank is not taken over. So I will bring the balance brought down in the cash bank account, 30,000. However, if the question would have stated that bank also taken over, I would have transferred bank here. In that case, I would not have brought down the balance of bank in the bank account, correct? Now we move over to the liability side. The first item in the liability side which you are watching down is 10,000 equity shares of 100 each, 10 lakh. So towards the credit side of shareholder account, I will not write balance brought down. I will write share capital account. Amount is 10 lakh. Reason being is that in order to close share capital, our entry is share capital account debit to shareholders account. So that is why I am writing share capital. After that, we have free reserves in the form of profit and loss account, 30,000. I will post it over here. Then we have general reserve. In this case, I will post it over here, 3,70,000. These are free reserves. Then we have liability in the form of 12% debentures. Actually, debenture is not taken over, but I have already told you, any liability, whether taken over or not, you are going to post them to the credit side of realization account. So 12% debenture, 1,50,000, you are going to write it over here, 1,50,000. Besides that, creditors are there. Creditors have been taken over. That's a different matter, but you are going to post them over here. Creditors is equal to 2,10,000. Correct? So now I have posted each and every item of assets and liability. Then I told you we have to take care of consideration. First, we make the due entry. Entry will be acquirer company account debit to realization account. Because of this entry towards the credit side of realization, I will write by acquirer company. I can write in bracket consideration due. Consideration we just saw is 16,80,000. And in the acquirer company account, I am going to write here to realization. 16,80,000. 16,80,000. Now we will receive the payment from the acquirer, and we just saw that acquirer is discharging 16,80,000 by paying cash of 1,80,000 and by issuing 1,00,000 shares of 10 each at the rate of 15. That means some portion is being received by us in cash and some in shares. So I'm going to write here by cash. We received 1,80,000 through cash, and we received shares of acquirer company to the extent of 15 lakh, 1 lakh shares of rupees 10 each at the rate of 15. The moment we are going to receive the amount, acquirer company account will get closed. Is it clear to you? Now, whatever cash you received and whatever you received actually, that is received by the owners of acquirer, logically both these things should be transferred to the shareholders account, because ultimately they will move into the hands of the owners. But because we are preparing cash account, so portion which we received in cash will be written towards the debit side of cash account to acquirer company account, 1,80,000. Correct? And shares which we received will be posted to the debit side. Shares of acquirer. Don't write here two acquirers, write here two shares of acquirer or shares in acquirer company. 15 lakhs. Why I am saying that you should not write here acquirer? Because logically shares of acquirer should be posted to acquirer to another account, shares in acquirer account, and from there it is posted to shareholders account. So we are trying to actually directly or indirectly to not to prepare shares in acquirer company account. So better whatever payment you receive besides cash, simply write it to the debit side of shareholders account, but take care in that case, don't write acquirer, write shares of acquirer company. Now purchase consideration task is also over. As I told you, if there is any asset which is not taken over and sold, but in this question there is no such asset which is not taken over and sold. Actually bank is not taken over, but bank cannot be sold. Correct? So we cannot pass any entry. If there would have been an asset which was not taken over and sold, I would have written here by cash. Similarly, there are two liabilities. Now 12% debentures are not taken over, so we will pay them off, and it is written in the question that we paid them at 10% premium. So 12% debentures will be paid. 1,50,000 they should have been paid, but we are paying them at 10% premium, 15,000. So total 1,65,000 we are paying them. Is it clear to you or not? 1,65,000 rupees we are paying them off. So nothing else is given in the question. So once you pay the liability, the next thing is to take care of expenses, but expenses are borne by the purchasing unit. So now we will have to tally this account. In order to tally this account, what I will do, our credit side is more, so whatever profit is there, that should be actually 1,55,000. This profit will be transferred to shareholders account. Balancing figure. So realization account will be closed at number 2. After realization account is closed, first of all, you write this amount, profit, in the shareholders account by realization. So realization profit 1,55,000. After realization account, you will have to tally cash bank account. Correct? But before I tally, I have written here 2 cash and I haven't done the cross posting of the same. So first let me write it by realization 1,65,000. Now whatever balance is there, 2,10,000 minus 165, so 45,000 is the balance. And I just told you that whatever balance will be there in the cash bank account, that will be transferred to shareholders account. Finally, I will write first of all in the shareholder account 2 cash 45,000. So finally now shareholder account will be tallied and it should get tallied of its own. 15,55,000 and 15,55,000 is the total of this account. So it is closed. Correct? So we have done correctly the entries part. Now, books of acquirer. As far as books of acquirer, as far as books of acquirer is concerned, you have to be careful that in this case, you will have to first of all pass the entries with respect to all assets taken over. Correct? First entry will be, we look into the balance sheet, there is land and building which we took over. Land and building account debit, that is 3 lakh. We are presuming that the book values are equal to fair value, 6,70,000, because no separate fair values are given. And then stock. Stock is 4,50,000. Debtors is equal to 2,50,000. Actually, I'm very sorry, I haven't written here goodwill. In this question there was goodwill also, I remember suddenly now. Sometime it moves out of your memory because most of the items remain in my memory. Yes, there is goodwill also 50,000 and we haven't transferred it yet. So write goodwill. Goodwill will be also transferred here, don't worry about. All assets, whether taken over or not, amount of goodwill is 60 or 50. Amount of goodwill is 50,000. So suddenly I got reminded, and please check this balancing figure because I write more out of memory than out of calculation. Correct? So it should be 155 only, don't worry about that. However, we have to keep the concept clear. So all the asset, whether taken over or not, you are going to transfer here. Goodwill is intangible asset, you will transfer it here only. So whatever assets we have taken over, we have also taken over goodwill. So I will write goodwill 50,000. Correct? Land and building we have taken over. Plant and machinery we have taken over. We have taken over debtors, but we haven't taken over back. And we have taken over creditors. Creditors are worth rupees 2,10,000. We haven't taken over debentures, so I am not going to write debentures here. So all assets and liabilities taken over, then I am going to write here consideration because this is the amount which we are supposed to pay. Consideration is of 16,80,000. Now if there will be difference, as we know under Ind AS 103, We write if difference will take place over here, we write gain on bargain purchase, and if it takes place towards the debit side, obviously I'm going to consider it as goodwill. In this question, balancing figure is appearing over here. I will write here goodwill on business purchase or business combination. This is your balancing figure, and balancing figure will be 1,70,000. So total goodwill now has gone up to 220, you may say so. Now we will pass the entry for payment of consideration. The entry will be consideration account debit. Consideration account debit 16,80,000. Correct? And I am going to write here to cash. 1,80,000 worth of cash I am paying. I will write here to equity share capital. We are offering 1 lakh share because we are the issuer entry, and the issuer will have to reflect the nominal value and premium value separately. So 1 lakh shares of 10 each, I will write here 10 lakh. And 2, security premium. 2 security premium. That is equal to 1 lakh. Security premium is 1 lakh share of 5 each. That is equal to 5 lakh. So this is how we will have to pass the entry. One more thing. In this case, there are expenses. Expenses borne by acquirer company. So acquirer company will write the entry profit and loss account debit. That is acquisition cost. As per Ind AS 103, acquisition cost incurred by acquirer must be expense. So that is why we are going to debit it to profit and loss account. Because generally under AS 14, we are following Ind AS 103. Under AS 14, expenses borne by purchasing company are generally debited to goodwill or capital reserve account. But here, we have to debit it to profit and loss account. That is the point, and that is the reason why I am stressing so hard. 10,000, 10,000. So this is how the accounting will run, correct, in the books of inquiry. Also, you need to understand this, that this concept will come into play only when acquisition is done not by way of acquiring control, but rather when we acquire the other entity by purchasing its net assets. In this case, concept of NCI will never ever come into play simply because we are not investing in the other entity. Is it clear to you? Also in this question, when we will do the accounting in the books of inquiry, in this question purchase consideration amount is given. Often we may face problems wherein we will find that purchase consideration is not given. So in that case, purchase consideration shall have to be found out. And in order to find out the purchase consideration, we will see there are 3 methods: and net assets method, intrinsic value method, and net payment method. So how those methods are applied and how the purchase consideration will be found out by application of those methods. These are the points which we are going to take up in the upcoming session. So I think in this session it is more than enough and sufficient, and we'll continue with vigor and strength in the upcoming session as we normally do. So till then, it's time to say goodbye and lovely good night from here, and God bless you.